It's Monday, July the 6th, 2026. You're listening to the DX Today AI Daily Brief. Today, world governments gather in Geneva as the United Nations opens its first global dialogue on AI governance. Tesla puts a hard cap on how much its employees can spend on AI tools. And a new report shows global venture funding has smashed every record on the books. Let's get into it.
The United Nations opens the first session of its global dialogue on AI governance today in Geneva, bringing all 193 member states to the table alongside industry, academia, and civil society. Running today and tomorrow, it's the first standing forum where governments will try to build common ground on how to steer artificial intelligence. The dialogue is co-chaired by the ambassadors of El Salvador and Estonia, and it leans on a new scientific panel led by researchers Yoshua Bengio and Maria Ressa. It convenes alongside the World Summit on the Information Society and the AI for Good Summit. A second session follows in New York next May. Backers call it the closest thing yet to a truly global table on AI.
From diplomacy to the corporate budget.
Tesla is putting a leash on its own AI bills. Starting today, the company is capping employee spending on outside AI tools at $200 per week, according to an internal memo reported by The Information. Anything above that now needs sign-off. The move follows months in which some Tesla software engineers were reportedly burning through thousands of dollars in AI tokens every week, after leadership pushed hard to get staff using the tools. There's a notable carve-out. Beta versions of Elon Musk's other companies' AI products, including Grok, are exempt from the cap. That's raised eyebrows internally, in part because many Tesla engineers reportedly prefer Anthropic's Claude for day-to-day work. It's a small memo with a big signal about AI cost discipline.
Next, an unusual offer to Washington.
OpenAI is floating one of the more unusual ideas in corporate governance, handing the United States government an ownership stake in the company. According to multiple reports, Chief Executive Sam Altman has proposed giving Washington a roughly 5% slice, worth around $42 billion at OpenAI's current valuation, pooled into a vehicle modeled on Alaska's permanent fund. The pitch would ask other leading labs to cede similar stakes. The logic: a government with a financial interest in AI's success is aligned with the industry rather than purely adversarial. Critics call it a bad bargain that would compromise a regulator's independence. The proposal lands as OpenAI prepares for a potential public offering later this year, and it's already stirring debate in Washington and Silicon Valley.
Now, a crackdown on access.
Anthropic is moving to slam shut the backdoors that Chinese firms have been using to reach its Claude models. The Financial Times reports the company has stepped up detection and enforcement after finding a string of workarounds that break its terms of service without breaking any law. Among them, Ant Financial reportedly gave staff corporate Claude accounts tied to a Singapore subsidiary, while ByteDance is said to have reimbursed engineers for personal subscriptions used over VPNs. Middlemen known as transfer stations have relayed prompts through overseas accounts, taking payment through Chinese apps. Anthropic is now watching signals like time zones and, since April, requiring ID verification for flagged accounts. It's a vivid look at how hard export limits are to enforce in a borderless cloud.
From access to raw compute.
Meta wants to turn its enormous AI build-out into a business of its own. Bloomberg reports the company is developing a cloud operation, known internally as Meta Compute, that would sell access to its computing power and host other companies' AI models, putting it in direct competition with Amazon, Microsoft, and Google. The motivation is financial gravity. Meta has guided to as much as $135 billion in capital spending this year on chips, land, and power, and renting out spare capacity is one of the few ways to turn idle silicon into revenue rather than a sunk cost. Investors liked it. Meta shares jumped more than 10% on the news. It's the clearest sign yet that hyperscale AI infrastructure has become a product.
Another giant reshapes its playbook.
Microsoft is betting that the hard part of AI isn't the model, It's the deployment. The company has launched a new operating unit called Microsoft Frontier Company, backed by a $2.5 billion investment and staffed by roughly 6,000 engineers and specialists. Their job is to embed directly with customers and actually get enterprise AI projects across the finish line, a practice known as forward deployed engineering. It's part of a broader industry shift. Just days earlier, Amazon's cloud arm committed $1 billion to a similar embedded engineering push. The message from the biggest players is consistent. Companies are struggling to translate AI pilots into real results, and the vendors who solve that last mile stand to capture the next wave of spending.
Overseas, a milestone in open models.
A surprising name is making waves in open-source AI. Meituan, China's largest food delivery platform. The company has released LongCat 2.0 under a permissive MIT license, a mixture of experts model with 1.6 trillion total parameters and a 1 million token context window. The most striking detail is where it was trained. Meituan says the model was built entirely on a cluster of 50,000 domestic Chinese chips, with no restricted American hardware involved. It's being framed as proof that China's homegrown silicon can now train frontier-scale systems. There's a twist, too. Developers had already been quietly using the model on a popular platform under the code name Owl Alpha, ranking it among the most used models before its true identity was revealed.
Back to the enterprise deal desk.
One of the largest AI services deals of the year just landed in India. HCLTech says it has signed a $1.14 billion agreement with a Europe-based Fortune Global 50 company to build and run an AI-driven operating model for the client's global digital workplace and enterprise networks. The contract runs from this month through the end of 2031, with an option to extend. HCLTech describes it as entirely net new business. The company hasn't named the client, though market reports speculate it's a major European carmaker. It's a reminder that beyond the frontier labs, the practical work of stitching AI into the plumbing of big global companies is becoming very big business for the world's IT services firms.
Now, a signal from the regulators.
America's top consumer watchdog is wading into how AI systems tell the truth. The Federal Trade Commission has opened a public comment period on a proposed policy statement warning that companies which quietly distort their AI's outputs to serve undisclosed goals could be deceiving consumers under the FTC Act. The Commission argues that people take AI answers at face value the vast majority of the time, so they reasonably expect those systems aren't secretly engineered to push a hidden agenda. The draft says clear disclosure is the way to stay on the right side of the line. It even singles out a Colorado AI law as potentially at odds with federal rules. The public has until the end of July to weigh in.
The money picture, by the numbers.
If it feels like AI is swallowing the venture capital world, the latest data says you're right. A new report from Crunchbase finds global startup funding hit a record $510 billion in the first half of this year, and the concentration is staggering. OpenAI and Anthropic alone accounted for roughly $217 billion of that, about 43% of every venture dollar raised worldwide. The second quarter set its own record, with more than $200 billion flowing into startups. The takeaway is a barbell market. Two frontier labs bend the entire industry's gravity, while later-stage AI companies compete for a shrinking share of what's left. It's the most concentrated venture landscape the modern startup era has ever seen.
Not everyone is cheering.
Amid the euphoria, one prominent chief executive is calling the AI boom out. Palantir's Karp, in a television interview, described the frontier AI industry as, in his words, insane, and accused the leading labs of imposing what he called a wealth tax on their customers. His argument, the companies selling AI tools are getting fabulously rich by charging far more than it costs to run the models, while the businesses buying them foot the bill. Karp was, of course, talking his own book. He's pushing lower-cost alternatives, including NVIDIA's Nemotron models, into government and enterprise contracts. But his broader point taps a real anxiety. As adoption soars, companies are starting to scrutinize whether the price of frontier AI actually matches the value.
And finally, the view from the job market.
We close with a number that's giving economists pause. The Labor Department's report for June showed the American economy added just 57,000 jobs, a fraction of the roughly 185,000 that forecasters had expected, and the weakest monthly gain since the slowdown of 2024. The report doesn't pin the miss on any single cause, and economists caution against reading too much into 1 month. But it lands squarely in an ongoing debate about whether AI and automation are beginning to reshape hiring, especially in white-collar and entry-level roles. With tech layoffs already climbing past 150,000 this year, many of them citing AI, the coming months of data will be watched very closely.
That's your briefing for Monday, July 6, 2026. For DX Today, stay curious.